Welcome to this session. Today our focus will be to discuss on capital gain tax. Just to appreciate what these gains are and the tax applicable on gains. So the most important thing first is to appreciate the tax provisions which govern taxation of capital gains. And the first section, of course, we will talk about the section 32F, which is the charging section. Section 32F, which is the charging section. Section 15.3F, which talks about the treatment of capital losses. Then section 34.1J, which speaks to the rate, and the 8th schedule, which is to the Income Tax Act, which basically then guides on taxation of capital gains. So as you can see, so the main provision is the 8th schedule to the Income Tax Act, which then guides on taxation of capital gains. Now let's try and define what these capital gains are. What are these? What is this tax? So we're saying this is a tax which is chargeable on the whole of a gain, which accrues to a company or an individual on or after 1st January 2015 on the transfer of property situated in Kenya, whether or not the property was acquired before 1st January 2015. So the Tax Act of 2014 reintroduced capital gain tax. So this tax was there in Kenya before, but it was suspended as a way of encouraging development in the real estate. So what we are saying is that from 1st of January 2015, then a tax was introduced to be applied on any transfer, on the gains on transfer. So then you need to take note of that. From 1st of January 2015, any transfer of property in Kenya will be subjected to capital gain, except for the transfers which are exempted from this tax as per the tax provision. So what we just need also to note is that the term property will then take the meaning which is provided in the Interpretation Act. It will take the meaning which is provided in the Interpretation Act. So from there, what we need to secondly understand is what constitutes a transfer. What constitutes a transfer? This is something we need to appreciate. What constitutes a transfer? What constitutes a transfer for purpose of CGT? So number one, we are saying, of course, when that property is once sold, or it's exchanged, or conveyed, or disposed in any manner. So if there's an exchange, of ownership, so in this case we are saying this exchange, even if it is by way of gift, this also then will constitute a transfer for purpose of CGT. Number two, we talk about when there is a loss of property, when there is a destruction of the property or extinction of the property. These conditions, if these conditions occur, when there is a loss, when there is destruction or extinction of the property, whether or not compensation is received, this will have to be assessed for CGT. So it is not only when there is exchange of hands, but also when there is a loss to that property. So especially when there is compensation from insurance, then that insurance compensation will be deemed to be proceeds from transfer, and that will have to be assessed for CGT. The last one is where there is abandonment. When there is abandonment of the property, when there is forfeiture, so the property is being forfeit, when there is surrender or cancellation or expiry of rights over the property, then these situations we have to do what? We have to assess whether there was a gain or a loss. In these three instances, we have to assess whether there was a gain or a loss for purpose of CGT. Then we need to discuss about the rate. So the rate for CGT, so the other aspect which we need to discuss is the rate. So you realize we are going systematically. So we started with the charging section. We've gone to what constitutes transfer. Now we're on the rate. So currently the rate in Kenya is 15%. It is 15%. So the other question is, who is liable to pay CGT? That is a question we need to ask. Who is liable to pay CGT? So the liability for CGT is on the transferor. The transferor is the person who is supposed to, transferor is the one who is liable to meet this obligation. So you realize on the other side, the transferee caters for stamp duty, but the transferor, the person transferring, the seller in this case, is the one who will meet this obligation. Is the one who will meet this obligation. So let's go to how to determine the gain. So how do we determine this gain for purpose of CGT, determining of the net gain? Now, so here what we need to consider. First, we need to determine what we refer to as a transfer value. We need to consider what is transfer value. We need to determine the transfer value, and then we need to come up with what we refer to as adjusted cost, so that then our net gain will be equal to the transfer value less the adjusted cost. All right. So our net gain is the transfer value less the adjusted cost. So let's determine the transfer value. We'll refer to it as A, the transfer value. So this, what we'll say, for us to get the transfer value, we'll take the sales proceeds. Sales proceeds. This is now the consideration. This is basically the consideration for that transfer. So you remember we've said it could have been even by way of gift. So if it's by way of gift, we need to determine the market value of that property being transferred, and that will become then the sales proceeds. If it is by way of compensation from insurance, then that compensation becomes the consideration. So we'll take the consideration. We'll take the sales proceeds. Then we'll need to less what we refer to as incidental cost at the point of transfer, at the point of sale. So this could say be agency commission, for example, agency commission. So if you are there to engage an agent to sell the property, then that cost to actualize the sale will be deductible for purpose of computing the transfer value. You may have engaged a valuer, so valuation fees will be an allowable deduction at this point. You may have engaged a lawyer, so there are legal fees. You may have advertisement cost, so you may have engaged an advertising firm to market the property. So all these and other related costs during disposal will deduct for us to arrive at what we refer to as the transfer value. To arrive at the transfer value. So basically we are saying the sales proceeds less the incidental cost will give us the transfer value. Now let's proceed to deal with the second part, the adjusted cost. So which will be our B. So the adjusted cost, simply we'll look at the cost of acquisition of that property, the cost of acquisition of the property, all right? Or so it could be acquisition or construction. You may have constructed the property. So this is the initial cost, the purchase or acquisition of this property, or the cost of acquisition. Then we need to add incidental cost at the point of acquisition. So this might include cost of defending the title for that property, cost of defending title. You may have defended the title. you may have improved. There are improvements. So maybe you've improved the roof. So you can you include that. The other aspects which you need to include here could be maybe say the rates and the land rent and rates you may have paid over time to basically still defend the property. There may be security measures you've taken, like a perimeter wall which you put up to sort of defend the property. So all these costs, then we add to give us what we refer to as the adjusted cost. Now once you have the adjusted cost, which is our B, so we're saying the gain then will be transfer value, which you get from your A, less the adjusted cost, which is your B. Now once you have, so this gain then becomes our C. So for us to get the CGT will say the gain, which you get in your C, multiplied by the rate, and the rate we've provided to us as 15%. So that is how you compute your gain on transfer of property. That is how you compute the gain on transfer of the property. So what also we need to inform ourselves is, in case there is a loss, in the event there is a loss, so if the resultant is a loss, not a gain, this loss will be carried forward to the future and will be offset against any gains from the similar source. So it will only, you cannot offset against another source of income, but against another capital gain. Now on the issue of market value we've discussed, where we're saying if the property was exchanged by way of a gift, then we'll have to consider the market value. This is where there is no consideration. Then we consider the market value. We'll have to consider the market value. Due date for this tax is the 20th day following that which the disposal was made. The 20th day of the month following the month when the disposal occurred. So there is an aspect of twinning. Twinning, what it refers is that we're saying stamp duty and CGT go hand in hand. They are like twins. So if there is a payment of stamp duty, then there is need to assess for CGT. If there is payment of stamp duty, then there is need to assess for CGT. Now the exemptions basically for the sale of property by property developers or property dealers will be exempted. Transfer of machinery like motor vehicles will be exempted. Transfer between spouses will be exempted from this tax. But then you need to refer to the 8th schedule for more information on this. You may refer to the 8th schedule for more information on this. So that's just an highlight on capital gain tax. And continue subscribing to this channel and being on the lookout for more discussions similar to this one. And just know that this is not a tax advisory, but just sharing of information. Thank you.